Chaikin power user and architect of cheat sheets. For those of you watching on a Chaikin channel, I can tell you that yes, we still use Chaikin and think of it as a tremendous application. For those of you trying to find Chaikin Power Trader on YouTube, for some reason, YouTube has decided to wind down the channel, claiming that we've trafficked in pornographic content. And I guess you could say getting screwed by the market occasionally is pornographic, but I'm not sure what the reason for that shutdown is, but clearly a mistake was made. For those of you following the channel for the last 12 years, all the videos are basically about using Chaikin Analytics. Today, we're going to talk about a different product, cheat sheets, really designed for new traders or for less capitalized traders. These would be folks that don't have the kind of money that you would need to put to work in the market to justify one of the most awesome and unique, groundbreaking software packages for getting a directional edge. It's sort of a quantitative and fundamental system. We call it quantamental, and that's Chaikin Analytics and the Power Gauge. However, that particular price tag is really not designed for folks who might have a $5,000, $10,000, $25,000 trading account. If you're running with a $100,000 account, you're investing about 2% of your portfolio net liquidating value in software designed to help you gain a directional edge. So perfect for large accounts, not so great for small accounts. Cheat sheets, while it's certainly not Chaikin, it doesn't have any of the fundamental modeling that Chaikin does. I would stack it up against Chaikin or any other trading system in terms of the aggregating fundamental trading characteristics into essentially a predictive algorithm that gives you a sense of not just where the market's at, but where it's headed using a powerful combination of trend, market forecast, relative strength, and buying pressure or Chaikin money flow. So that combination of ingredients is what goes into cheat sheets. The fundamental portion of cheat sheets where we look at market indexes, sector ETFs and ETFs is free. It'll always be free. And for those of you who are option traders, for example, you might not need another thing. For those who want a deeper dive into stocks, fundamental stocks that are better in breed and more likely to go up, small caps of companies that all have cash flow and no debt, dividend dominators, companies that have been raising their dividend each year for at least 25 and in some cases 40 years. We have a stack for that. We do commodity ETFs to kind of represent the global flow of raw materials and energy, and a number of other cheat sheet stacks, including a double short ETF stack. So when the market does go down, for those of you not comfortable trading in a short direction, borrowing stock or using put options, you have the ability to use a bullish trading strategy to bet against the market. So for more information for all of this, you can go to stockcheatsheets.substack.com and sign up for the free and or paid subscription. Start with the free. Get used to it first, especially if you're just starting out. There's no reason to pay me yet. Catch a free ride for a while. And then when you're comfortable and ready to expand and you've developed a winning expectancy out of the sector, subsector, and index ETFs, then the $5 a month that we charge you for the deeper dive is so worth it. All right, give me a second here. The one thing I forgot to do before I started here is I need to be able to share my screen so that you can actually see what I've prepared today. We're going to get the vortex of death. It can't be helped. Get ready to go down the rabbit hole with me. There we go. All right. So I'm going to head over here. And so this is our playbook and let's make sure I've got a good, let me give you a better view than that. You don't need mostly me. You need mostly data, and less of me is more, especially because I haven't shaved in a week. All right. So this is our pre-market playbook. Trading beginning on Monday, August 22nd. And I will be sending out cheat sheet stacks shortly after the broadcast today. So if you happen to catch this live on social media, you don't need to email me and request the free stuff. It'll be coming to your inbox if you've given up your email address at stockcheatsheets.substack.com. All right, let's get going. It was a down week for the markets last week, and not a surprise, and not significantly down. In fact, for those of you who got an email from me with sort of a heads up on Friday, around an hour before the close, I think I told you that there was some concern about the junior timeframes on the market forecast tool. Don't worry if you don't know what that is yet. I'm going to explain it. That it looked like the momentum was going to be strong enough to the downside that we might be looking at intermediate trend interruption, possibly a consolidation and an outside chance at a reversal eventually. But the market's kind of recovered. So one of the things I promised to do, I will do in today's session, and then in the follow-up cheat sheet stacks that I send you, is we'll see where the momentum and near-term lines ended up. Turns out they ended up where they needed to be to remain bullish, and as a result, tons of buy the dip signals. So we're going to show you which buy the dip signals are worth taking advantage of as soon as the open on Monday. What is definitely should be put on hold until the last part of the trading day, just to make sure that red momentum line doesn't slip below 5, creating a bearish danger zone signal. And of course, then there's going to be some other trades we may want to either take off or do some hedging based on what we see. So we'll try to walk you through as much as we can. I got to keep this video to under an hour. So it's we'll call it 105. I know it's not quite that. We need to be wrapped up by 2. I'll try to do it even faster than that. Okay. So the markets down a little bit, up against resistance. Diagonal resistance connects a series of lower intermediate peaks. You're seeing kind of the close-up version, but there was about 3 during the downtrend that lasted the first half of the year. And we also have the 200-day simple moving average, one of the most followed moving averages, not part of cheat sheets architecture for as far as trading signals go, but a very important level of either support or resistance. The market had a death cross about 2 months into the bear market. That's where the 50-day moving average crosses below the 200-day moving average. And a lot of traders just say, as far as bullish trend following goes, that's it, I'm out. Talk to you again when the blue line, 50-day moving average, is back up above the 200. So for those traders, this particular configuration has been nothing but a bear market rally rip, more likely to fail than not. Now, it hasn't failed, but until we get through this 200-day moving average and certain cheat sheet indicators turn from mildly bullish or bearish to more bullish or somewhat bullish, then we'd have to agree that right now it's still a bit, even though it's lasted 2-3 months, this rally is nothing more than a rip to the upside in the context of an overall downtrend. Now, the question becomes, are we going to roll over from here? And if so, similar lows, lower lows? Cheat sheets isn't going to be able to help make a prediction that far out, but what we are able to do is give you probabilistic evidence for either a trend continuation, an intermediate term consolidation. That's where price might pull back to, for example, the 50-day moving average, and we might get a series of compressed lower highs and higher lows, kind of like squeezing a tube of toothpaste. That sort of happened here to the downside. And you can see eventually that toothpaste tube got so tight it squeezed the toothpaste out the other end of these converging, not a word, but it's a good word. I like converging. Converging moving averages squeezed the toothpaste out, and down we went. All right, so now we're recovering and hit our head on the 200-day moving average. For some people, including me, even though I'm still not bearish, I actually sold some out of the money premium. That's where you basically sell other people the chance to gamble on a breakout to the upside by selling call options. In my particular case, a risk-defined version called a call spread. It's a little bit too time-consuming for us to cover today, but it's something I strongly recommend that you go on to Investopedia and learn about. It is a way, especially in a retirement account, where you're not going to be taxed on the short-term income. It's a chance to raise some cash on stocks that you already own for no more added risk. It's about as close as we get to free lunch. It's not exactly free because there is one risk you are taking. That is, if the market were to rip to the upside, you are potentially blocking your ability to maximize gains. If your bet is directionally up, but you've sold away the rights to your stock at a higher level. Okay. So where is support? Most likely the 50-day moving average. And I suspect until we get through another jobs report, and a few more inflation reports, and a Fed meeting in mid-September, that we're probably looking at, we're less likely to be ripping higher. There's always a chance the data sort of helps us front run the Fed, and we get ahead of the market based on what's going on. And so there is a chance we could rip to either side depending on what the data says. Okay, but I think the most likely scenario is hockey pucking around between the two moving averages while we wait for more definitive, longer term direction from the Fed. Okay, so the intermediate forecast right now, which we're going to get to next, is bullish. You can see the green line. You're going to see it much better in the slide that follows. Green line is above 80. That's the intermediate term indicator. On cheat sheets, it's factor number 7 on the pre-trade checklist. The green line is our intermediate forecast. This is essentially an oscillator. Oscillator is a momentum indicator that tells us whether or not price is accelerating to the up or downside. That happens to be part of a 4 time frame indicator called the market forecast. Okay, before we get there, I just want to touch base on this one more time. I blogged about this earlier this week. I've even videoed about this. So I'm going to spare you the long form narrative. But remember what the RSI is. It's taking a series of 14-day snapshots, rolling snapshots, and essentially tracking whether the market closed in the green or in the red for the day. And the more days that are winning out of 14, and the more times that rolling 14-day period, 14 trading day average has winning occasions in it, the higher the RSI gets. Now, like anything else, it's going to approach its limit because this is an oscillator that is basically, think of it in percentage terms. There is no such thing as 101% on an oscillator. So it's between 0 and 100, but basically what it's saying is it's looking at any 14-day snapshot, 14 trading day snapshot, and telling you what if this was a baseball team, it'd be telling you what their record was, right? Are you 12-2, 10-4, 7-7? Well, if you're 7-7, your RSI score is a 50, right? Halfway between the winning 100% win side and the 100% lose side is 50. And anything above 50 means that your winning percentage is better over 14 days. The most recent 14 days is better than 500, better than 50-50. And the higher your winning percentage goes, the bigger your RSI score goes. And the idea here is as stocks intensify and their trend, the more relentlessly bullish the trend is, the more winning days versus pullback days you get. And so the RSI starts climbing. But just like a team going on a winning streak, you only can maintain that momentum for so long until mean reversion takes place. Now, the odds of an up day for any stock, the actual odds are probably just a little bit better than 50-50. The market has an overall upward drag to it, but really when you look at any individual trading day, it's a 50-50 shot about whether you're going to close higher or lower on the security that you're interested in. Compared to before the market opened. And so over time, the odds never change, right? It's always going to be a 50-50 shot, but odds are different than probabilities. Statistical probabilities say that it gets increasingly more difficult to fathom when the true odds are roughly 50-50 in terms of outcome. When the market is closing with more up days than down, then eventually mean reversion is going to kick in, right? It's a 50-50 odds of a winning outcome. And for the most recent 14-day period, you've had 70% win rates, and you've had 70% win rate for several months. There's a chance that you're going to encounter, there's more than a chance, it's a probabilistic certainty that we're going to have some mean reversion, which means that the RSI will roll over and hit a low. Probably a higher low, especially if the stock is just taking a break and consolidating over a period of, now we're not talking about a pullback. Okay, pullbacks are 2 to 5 days in the context of a rising RSI, a rising price trend, a rising moving average. An intermediate pullback could actually have a series of very short-term lower highs and lower lows. Sometimes you'll get that toothpaste tube pattern where stocks coil up into some kind of price pattern and then break out to one side or the other. That's very typical in a intermediate term consolidation. So if the RSI, which has now fallen below its upper reversal zone here on the SPY, that's an indication that the trend, not the trend is reversing, the trend is, remember this is momentum, so it is weakening. It's decelerating. So it's not that the car is turning around and going the other direction, but the car is slowing down. Maybe there's a bunch of traffic forcing it to reduce speed. And the traffic in this case would be the resistance of the moving average, with more sellers coming in saying, okay, I've had a nice little run since June. I'm not that bullish on my fundamental analysis of the market. Time to start taking profits. And that's probably what's going on here. And so some of us are selling are still bullish, but selling a little bit of a premium outside of the 200-day moving average to take advantage of that selling, to try to potentially sell at one price and buy it back at a lower price, right? That's another way to win. But my underlying holdings that are my trend following system holdings are still in place unless they've hit the stop. So here's a look at the market forecast now in a little bit more detail. I've just widened it up. You can see we're bullish, the green line above 80. And it means we're very bullish, right? There are 3 stages to bullishness. There's rising, but below 50. That would be in cheat sheet lexicon, that would be neutral plus, good, but really weak. And then there's above 50. That's probably optimal, because it means not only is the trajectory of our trend solid, but there's room to run. We still have 80 to cross and 80 to live above for a while if the trend turns out to be a good one. So really, green line above 50 is the optimal position to be in for the likelihood of a trend lasting closer to 3 months as opposed to 1 month. Remember, this is a 1 to 3 month indicator, a weeks to months indicator, but it will tend to last maybe only one cycle and shorter, a month typically when it's a really weak intermediate trend, 3 months when it's a really strong one. And when it's a really strong trend supported by the next senior time frame, which is the months to a year or two, 9 months typically, is the life cycle, the bullish life cycle for this, the market sentiment line, also known, I think on cheat sheets, we call it the long-term forecast. So right now we have a rising long-term forecast. We would call this neutral plus because it's below 50, but above 20. It is the lowest position you can have and still be bullish. So weekly bullish, long-term forecast, very strongly bullish intermediate term forecast. When this turns from below 50 to above 50, it's a game changer in that we now would bake into our assumptions multiple green line runs from a little bit weaker to a little bit stronger. So in other words, after this thing does its, it's really just about completed it. It's a lower reversal zone to upper reversal zone run, the first kind of leg of a trend that will likely last 3 legs. When this line breaks above 50, then we'd expect this line to maybe curve down for a little while, but never get back down here into the lower reversal zone, just but maybe below 50 again. You can see the market stayed bullish despite the fact that we had an intermediate pullback. And you'll notice an intermediate pullback is a little bit more complex than a 2 to 5 day pullback. This one looks like it lasted maybe 3 weeks, something like that, just eyeballing it. And then the line reversed and we ran up again. Now it turns out we were really close to the end, right? The market top followed right afterwards, but we can't see what's to the right of our charts. So we had this line going up and we had this line going up and we had price going up. And then some stuff happened and it was over. But my point is there were multiple legs to the uptrend. Now, some of them weren't that great, but overall, it looks like this particular uptrend, and I'm not even counting this intermediate pullback. There's probably another leg up over here. As a matter of fact, I'm going to assume it because we were just so bullish last year that we had a leg up 1, intermediate pullback, leg up 2, intermediate pullback. Of course, we got bearish here. But then we had a shorter leg up here. Okay, so at least a couple of runs of intermediate strength. And that's what we would expect, especially if this guy can get above 50. Okay, so that's the bullish case. What could happen in the bearish case? That would be if the junior timeframes fall outside of their comfort zone to the downside. That would mean we do like having this blue line fall below 50. Remember, this is the near-term line, swing trading time horizon. It's kind of one time frame lower than the green intermediate time frame, which is one time frame lower than the gold market sentiment time frame. And of course, the momentum time frame is even lower still than the near-term line. These two together, blue and red, represent junior time frames. So when senior time frames are bullish and junior time frames are indicating safe levels of weakness, I guess is the way to put it. Price is pulling back or flatlining, but it's not at levels that would mean that institutions are really trying to get out of this position. Okay. So you want the near-term line to, when a pullback is in progress, go below 50, but stay above 20. And we want the red line. Yeah, it can get below 20, but it has to stay above 5. Okay. And there's another twist on this. The red line can sometimes get below 10, but stay above 5. I call that a heads up. It's definitely still a valid signal, but sometimes I like to be extra cautious when we get that low, since it's so close to that below 5 line in the sand. All right. Let's look at the candles on the weekly basis, just to kind of give us an idea of the scope of what we're dealing with, which is really a mega trend. COVID bottom through late last year and a half of just relentless up move. Looks like we had maybe about a 1/3 retracement bounce. We've recaptured maybe half of what we lost. I'm just eyeballing this. I could actually draw Fibonacci lines. But notice that in addition to the 200-day moving average, we're pressed up against this series of declining highs. Okay. And we have, on a long-term basis, declining lows. So still in a overall long-term downtrend, we need to break through this. We're at a critical juncture right now. Market needs to swoop up above these resistance lines and hold it. And then we're talking about the birth of a new bull market. Or we may fail and come back down and retest the lows or even exceed them. And that means this, in retrospect, will have been like this one, only double the size, triple the size, a bear market rally. These are very typical in bear markets, and bear markets can last 18 months or longer. And we're about 9 months in. So still plenty of room to the downside. That's why we want to watch the data really close. And we also want to watch other indexes. The SPY is large cap 500 stocks. The IWM, more economically sensitive. The 2,000 smallest publicly traded companies that aren't on pink sheets. They're actually on an index exchange. It's called the Russell 2000. And this is the ETF that symbolizes that. It's called the IWM. Notice price is actually stronger here than it was for the SPY. We are through that diagonal resistance where we're pressed up against it in the large cap index. We also got through a horizontal, what was former support, acting as new resistance, but we blasted through that. We really haven't come back down and retested that. That's a very typical thing to do. Whenever we kind of get through a level, we'll usually come back down and validate it. Now, we did that to the downside here. You see we broke down below this support line here, and then we threw back and retested. It's not perfect. Remember, support and resistance are always areas, not exact points. And sometimes we'll come back and test an old support area now acting as new resistance, and we won't get an inch. You can see we're up against 2 resistances at this point, diagonal and horizontal, and we didn't make it. We had our last leg. This was if you remember, I was blogging saying, the market correction has been really orderly. It's time for, this is my best call of the year. You can go back and check the date. It was mid-June, June 12th, I think, or 11th, where I said on cheat sheets, we're due for a cascading downward move. And then we got it. And that was our bottom, our capitulation move to date. All right, and up we come. And now we expect throwback retest bouncing at around 190. So potentially another $4 in downward move for IWM at a minimum. This is interesting. Again, we're on the weekly time frame. That was the daily before. Through that diagonal resistance, and we just melted through both diagonal and horizontal like a knife through butter. We didn't slow down, which happens. We do have an interesting candle pattern here. And we had one on the SPY. I skipped it. It's called a hanging man. Or no, it's a shooting star, I think. But basically let's go back. I'll just show it to you. Shooting star. So you see long wick, little body here at resistance. Traders tried to trade it up, maybe through the resistance during the day. Late in the day, other traders came back, sold the position, hammered it back down. But it's not called a hammer when it's at the top of a run, only usually at the bottom. This is called a shooting star. Not the best shooting star in the world because the wick is a little bit small, but it'll do. And then this is called an inside day. That's where basically price stays with a bearish price candle, where we open at one level and close at a lower level, stays inside the parameters of the previous day's bullish candle. And that's just called an inside day. Nothing that magical about it. It's just that that the next move usually, this signifies a short-term top, and the next move is usually lower. And it could be just down to this level, assuming that this is truly a breakout and this was actually resistance. We should come back down here and maybe test this level, or we'll come back down and test diagonal. Probably more likely we do that. So I think there is some downside, but not massive selling, at least not yet, at least not based on the data. I know that the gloom and doom prophesizers are out there whipping up a storm right now, especially the big short guy who's sold all of his stocks except for one little prison firm. Okay, and this is finally the cues. The tech stock was the most beaten up area of the market, and it's been one of the most buoyant on the way back. Usually we don't have the folks that take you away from the dance floor. They don't usually lead you on to the next one. So again, I'm a little skeptical that this is the bull market rally that defines the next 5 to 7 years, but it's possible. More likely a bearish leg up. And again, I even drew a couple of lines here just to suggest that we're kind of at resistance, not through it, but we'll see. And again, not a really strong inside day candle, but you can see the week before we had this thing called a hanging man. And then I guess sort of a hammer / shooting star-ish thing. Not a very good version of that. But basically some consolidation here at a significant point of inflection, which is really what this is, right? Buyers and sellers equal each other at certain inflection points. And this is the ACWI. Now, I wanted to bring this up. This is the All Country World Index. It's an equity index that's market cap weighted for every stock market that's publicly traded from around the world. And I do mean everything from frontier markets to the US and Canada and China and the UK and France and Britain and Germany and the G10, the G15, the RSX no longer part of the ACWI. But that's about it. And I would argue that I wouldn't call this breaking through diagonal. I think we're at diagonal resistance right now. In fact, if anything, we turtle headed above diagonal. And I do worry that, because the rest of the world is a little bit weaker than the US, I do worry that whenever we see even the hint of a failed breakout, the move in the other direction is usually fairly extreme and pretty quick. So I'm actually going to watch this index because of this little turtle head move that could cause a big rebound to the downside. And that would be, I think, a canary in the coal mine. All right. So in terms of the real economy and companies actually justifying their stock price with earnings, because I think earnings are going to be a big part of earnings estimates are going to be a big part of the direction of the stock market for the next 6 months as we try to anticipate two things. What are the S&P 500's earnings going to be, and what price are we trading against those future earnings? Right now, the market's trading at about an 18-to-1 multiple, certainly not the highest it's been, but if we have an earnings downgrade, you can be sure that 18-to-1 multiple will get beaten down to 14 or 12 or maybe even single digits and in a hurry. So we do pay attention to this, and we notice that just about well over 9 in 10 companies now having reported second quarter earnings. I think it's about 475 total have reported results. And, the EPS beats are interesting. The fact is that we've kind of held pretty well, right? Considering the much higher input and labor costs that companies are having to absorb. And there's probably a limit to how much higher prices they can pass along. To see the EPS slip only 10%, I think is pretty encouraging given all that's going on in the world right now. The revenue, you could see the top line being challenged as the economy slows down and as the consumer goes into more debt. Read a report that, one of the Fed reports that I pay attention to, which is the kind of how much we are putting on our credit cards. That number was a big number, biggest number in 40 years. So Americans are absorbing high prices by not necessarily out of the cushion that they've got through their paycheck or savings, but no, are putting on the credit card, revolving credit at whatever, probably in the low 20s in terms of APR now with the Fed rate hikes happening. That affects interest rates of all over. So revolving credit is going to be an ugly nemesis. And so that is the backdrop, and consumers drive the economy, and the revenue beats are getting less and less. 83, 68, 69, 67, 63. We're coming down, and we're putting more on our credit cards. So that eventually is going to catch up with us. Okay. So there are some reports that we'll want to pay attention to in the next week. I've laid them out here so you can screen grab them if you want. I'm not going to go through all of them. I think you know the ones that are going to be really important because the Fed pays attention to them. Anything related to the job market. And experts are expecting, well, actually, this was last week. We came in lower than expected for jobless claims. So believe it or not, I don't know if that's good news or bad news for market watchers right now. I think anything that suggests a more inflationary environment, so meaning fewer people lost their jobs than we would have expected, might be bad news because that the market is going to game the Fed, right? And anything that's going to lead to more prolonged interest rate hikes is probably not bullish for stock prices. I know that's kind of twisted, but it's likely the reality. I don't remember what the reaction of the market was. And then business inventories kind of flat, which is actually good news because one of the things we were concerned about is the over ordering that's going to lead to businesses having to do the everything must go sale and taking their inventory and discounting it heavily, which will eat into profits, which eats into EPS. And so these were the wins. These were the losers. What was lower than expected? Housing market slowing down. That's actually probably good news for Fed watchers. Housing starts slowing down. Consumer having to put stuff on their credit card. We also have the company I work for, my day job is New Voodoo. We just did a massive consumer study, and this was on food, grocery shopping. 30% of Americans over the age of 18, and I mean every demographic cell, are cutting back on not just eating out, but that's 30%. Another 30% are cutting out their the actual groceries they buy, let alone the non-grocery stuff. I mean, you have to eat, right? So this is to be expected. And then existing home sales, slight cooling. And then this is what's on tap for the week. I think the biggest events are going to be the Fed head gathering of the beards in, wherever that is, like Wyoming, I think. It's that big Jackson Hole gathering. And the reason is because the gum jobs are going to speak, and Jerome Powell is likely to, do something that maybe tells the market that since the last Fed meeting, what they're thinking about in terms of they're very data dependent. And so we'll maybe get a hint here. And then I think of all the other stuff, and it's all important. Durable goods speaks to the, the health of, because you can always, you don't need that new washing machine unless it's busted and you've got to wash your clothes. You can put that off. So the more durable goods that pull off, the slower we get, the more likely the economy is slowing down. Again, that might be good for Fed watchers. So any kind of economic malaise news actually might be bullish for the market, and vice versa. Anything that, points to inflationary trends. I see you're going to see something in energy. We might be the first in the country to spot this trend, but there's something potentially inflationary coming. We'll have to see. Personal income and spending, all of that important, but the PCE number is going to be the big one. Remember what that is. That's basically the price changes in core and non-core household consumption items. Now they'll strip out food and energy and claim that the real number is the core number, and energy has come down. It's really the only thing that's come down. So I guess the core number will be an indicator. It was terrible last month. We grew 66.8% annualized and a percent month over month. Those were the biggest increases we've had since January 1982. When look at this face, look at this old face, gray face, graduated high school. That's a long time ago. And core, speaking of which, excluding food and energy, they're expected to rise just slightly under 5%. But they were at 4.8% in June. They're expecting 4.7. I would bet you that given the fact that energy costs came down, if this number does not go down, then that's super inflationary. And that's going to be probably enough to roll the market over because the Fed is guaranteed probably to do 75 basis points at that point. All right, we'll also get personal income spending, our trade balance numbers, and the consumer sentiment index, which has also looked just terrible. This is a revision, previous number already released. So that's the backdrop, right? A lot of information coming this week. So then we use the data. That's kind of everything that I've shared with you now is basically me telling you what I think, right? Which is not that valuable. Pundits are just not that valuable to traders. What's valuable is data, especially data that proves itself as a leading indicator, okay? And that's what we try to specialize here in cheat sheets is at least state of things as of now and where we're likely to be headed here in the near term. Now, it's harder to do intermediate to longer term. You do have to sort of extrapolate economic data to do that, which is why I do follow it. But really the action is here. For those of you unfamiliar with cheat sheets, basically it's a series of different curated stacks of ETFs that represent some parts of the international or US economy. This is very much a US themed investment product, and it is most certainly slanted to the bullish trader, not designed for short sellers and bearish option sellers. Okay, so this is all about kind of investing or trading for bullish gains. All right. So yesterday, you can go look at the blog at stockcheatsheets.substack.com. Just checking the time, 1:42. We got 18 minutes. So we checked the blog at stockcheatsheets.substack.com, and you'll get a whole relative strength report. That's going to be much more about where we think the puck is headed. This is sort of a state of the union, and this part of cheat sheets is probably the most speculative. It's a forecast, pretty reliable one where we can make some probabilistic bets that actually give us an edge in terms of the direction of the market. I'll explain in a minute. All right. So reading from left to right, you get your ETF, and then based on the color code, we'll tell you what type of ETF it is. And we also have a little abbreviation here, but we organize 3 types of ETFs into this stack. Index ETFs, which are exactly like they sound, like the S&P 500 index, the ETF for that index of the top 500 large cap stocks in the US, SPY. That is actually incorrectly labeled as a subsector. I need to fix that. That is actually an index. And then we have, and another example would be a DIA index, Canada, EWC index, ACWI, the All Country World Index. This may be an extra SPY that's in here. Yeah, here's the SPY in the index. I think I just left this in sectors. So I'll try to fix that before I send these out to you. Just a little clerical error. All right, so that is probably, that is the most important stuff. And we stack this all based on the tailwind score. The next category are sectors. Sectors are swaths of the economy underneath an index. So utilities is our top index, followed by energy, followed by consumer staples, followed by healthcare. By the way, those are for what we would refer to as defensive ETFs. Those are stacking the highest. So the reality is, as of right now, the market is placing the most value based on these tailwind scores on the stuff that has the least damage potential if the market were to go down. Okay. Healthcare, utilities, consumer staples, and energy. You have to fill up your car. You have to get your Colgate toothpaste and your Campbell's soup. That's consumer staples. You have to go to the doctor and get your teeth cleaned, right? That's healthcare. And if I didn't say energy, you have to fill up your tank, and utilities, you got to pay your electric bill. And so there you go, defensive. Then what's next? A couple of indexes, SPY and IWM, followed then by more cyclical, the economy is roaring type stuff. Still very highly rated in the high 50s, not as good as it was, but still there, still bullish, XLI, XLK. And then we have KIE, which is insurance, part of financials, XSD, part of tech. You can see these are now subsectors, SUB, also better known as industry groups. So there can be multiple industry groups within a sector, and a sector fits into an index along with other sectors. So think of these as level 1. These gray ETFs as level 2. So level 1, level 2. Hopefully you're seeing my pointer. And the subsectors are industry groups. So for example, KIE, which is insurance, would be part of financials. XLF, which I don't see on this page. KBE is big money center banks, the too big to fail banks. And then we have regional banks. So each of these three subsectors or industry groups are part of financials ETF XLF. And those three happen to be outperforming, at least in terms of their score as of today. All right. So where do these tailwind scores come from and what do they mean? Well, think of them as a relative grade. So of all the slices of the US economy and the world stock markets, these are the most valuable on a relative basis. And that value, the only part of cheat sheets that's really proprietary is how I mix these factors and how they weight into the tailwind score. Because my job is to basically help you predict which ETFs, which parts of the US economy are likely to do better than others from an investment standpoint, right? That's the whole idea of this is a meritocracy where we're basically, it's a grade and trade. We are trying to use as much information as we can about how big money institutions are dealing with these ticker symbols. And then we are organizing them as a meritocracy from the best in breed that we think at the moment to less best, not necessarily worst, right? You can have everything in a bull trend, but the stuff at the top is got the most potential. Okay. So these 10 factors combine to produce this score. The first three factors are snapshots of current trend. We use the 10 and 40 exponential moving averages for the long-term trend. We use the weekly moving average pair. For the intermediate trend, we're looking at the daily charts. And for the short-term trend, we're looking at hourly. So the 10-hour moving average above the 40-hour moving average would be bullish in the short time frame, 13 minutes. After that, buying pressure. This is also known as Chaikin money flow. Chaikin money flow is a way of basically approximating on a relative basis whether institutions are accumulating a stock or not. Think of that exactly right. Very bullish, and bullish means you've got the big trading entities, the pension funds, the investment banks, the trading desks at the big retail banks who, short the market when investors are buying and buy the market when investors are selling. Those guys, when we have high buying pressure scores, it means big institutional investors with access to limitless research budgets and all the sophisticated algorithmic predictive modeling software. If these guys are buying and gals, there's a good chance the stock is going up because he or she who controls the many millions that go into the stock market are the stock market. Okay, so supply and demand is direct byproduct of buying or selling pressure. Okay, so that's an important factor. Then we have relative performance. This is equity performance related to the Russell 3000 or the ETF IWV. So more relative strength, the better. And of course, since we're grading everything based on its relative position, pricing position to the IWV, then we are comparing all of these ETFs to one another by extension. And then we get into the market forecast, and this is what triggers a lot of these signals over here. So in general, I think of us as being bullish or bearish when I see a lot of danger zone lights lighting up. Now, there's a few that have lit up here. What does that mean? It means the momentum line below 5, okay? Anything that's in a bullish trend, and right now we only would consider trading directionally these 5, right? So, and these are all subsectors that are still hanging in there. Biotech, innovative tech, technology. These are very closely related, but not exactly the same. One is more, think of one as more legacy hardware, software platforms. The other is more disruptive tech. And then we have home builders, believe it or not, and metals and mining. Those are what are most bullish as of the moment. Now, some of these that are scoring heads up, remember what that means. It means that the red line came down. It's healthy, right? It's between 20 and 5, meaning the 2 to 5 day harmless pullback in progress. But because there's a heads up sign, I put it there. This was me building this in. This is just a, hey, you might want to give this another day in case price keeps going down, right? So otherwise, a buy the dip signal still triggers when a heads up shows up. Notice that it doesn't trigger when a danger zone shows up. These would probably otherwise qualify for buy the dip, but the signal doesn't happen because the red momentum line has slipped below 5 and or the blue near-term line has slipped below 20. Okay, those are the two indicators that when they light up in the bearish direction in the deep red are suggesting that, yes, that trend could continue, but a bounce entry, meaning a 2 to 5 day pullback, and then you wait for the bounce or the buy the dip signal, you get back in and the stock keeps running. For the most part, well, nothing is ever guaranteed in trading, but more often than not, you're going to run into a situation where the stock is going to consolidate. It may pull back into a series of short-term lower highs and lower lows. It might just go sideways, but not just for a few days, potentially a few weeks. And again, I've maintained that between now and maybe the next Federal Reserve meeting, the market might drift between the 250-day moving averages, sort of in that no man's land. And so wherever we have a danger zone, but a bullish trade, I'd immediately take it off the table, let it prove itself through another cycle, meaning red line gets out of the zone and then comes back in, and we wait and see what happens. Do we get bullish signals that kind of negate these, where the oscillator in the case of the momentum line will trigger I don't see one, but there's a bullish signal here, dark green, where the oscillator gets above 80. And in some cases, a really powerful signal is that oscillator gets above 95. Okay, that happens. It's called a bullish reversal. It negates the danger zone bearish trade. Okay, so danger zone is absolutely a deal breaker for me. Now, a heads up is a valid buy the dip signal, but one where I say wait one more day to make sure that red line doesn't close danger zone the next day, because flew a little too close to the sun. So that's my own interpretation of the market forecast. It's a little extra layer of safety. Otherwise, for a lot of traders, this is lighting up green, the heads up, and you're buying the dip. Okay. So let's go look at a danger zone trade. Let's look at XITK Innovative Tech. And now, what are my other rules for taking a buy the dip signal? Now, we don't have a buy the dip signal because of this, but what else is important where we do have a buy the dip signal? We need to have at least the intermediate trend. We'd prefer both long or intermediate, but we'll settle for the intermediate trend. In a recovering market, we pretty much have no choice. Okay, so if you're going to take a buy the dip, this would be my strong recommendation. I don't give advice. This is just data, and it's up to you to make your own trading with this, but I'm just trying to help you along. Maybe a better way of saying it is, here's how I would interpret the data. Long-term intermediate trend, one or the other must be bullish, preferably both. Okay, I don't care about the short-term trend. It could be doing either. Buying pressure must be neutral plus or higher. Okay, I do not want liquidation or distribution, so I'll take just a little bit of buying pressure, which would be a neutral plus. I prefer bullish or very bullish. Okay, that means shaken money flows over 0.1 or 0.2. All right, relative strength, typically important. I would say that the 6-month relative strength, at least neutral plus, preferred. Again, not a deal breaker the way this is a deal breaker. Okay, we're coming up on the next deal breaker. Whoops. Sorry about that. Next deal breaker is long-term forecast. That gold line needs to be at least trending higher than 20 and in a positive direction, i.e. neutral plus. Okay, prefer bullish, but you're not going to get that early in a recovery market. Okay, we've been 2 months in a trending market and most are still neutral plus. That's a non-negotiable. This one too. Intermediate forecast line at least neutral plus, meaning we've broken up above 20. So it's like the football team on the 1 yard line. That's the minimum that we'll accept. Okay, so neutral plus, bullish or bullish. And then the near term and intermediate or momentum line, we just do not want danger zone. Okay, heads up, okay, danger zone is not. And by the way, this is the first tier. I know the second tier looked a lot more bearish. I just want to make sure you understand that 53 to 71 here on trading signals, first tier. So what's what's working in the market: oil exploration and production, utilities, telecommunications, energy, consumer staples, and healthcare. 5-minute countdown. I'm going to move on. I'm going to give you access. Everyone will get access to premium trading signals today. Okay. This normally comes with a $5 a month request for these signals, but today I want you to see them. Okay. So most liquid ETFs, this just helps option traders. Tons of buy the dips, stay away from the heads up. Yes, I've got, so this is probably my best trade here. UNG, buy the dip signal, bullish in multiple time frames. Buying pressure is not the highest, but it's a 5 on a 6-point scale. Relative strength, outperforming the IWV in both the 3-6 month. Long-term forecast is at least rolling above 20, so neutral plus, and a very bullish intermediate forecast. Prices pulled back, but we've stayed while we're below 50 in the neutral zone. We have not breached 20. That's what neutral 20 zone means. Okay, if you see neutral, it's good. Neutral 10 to 90 zone, that means we've stayed above 10. Remember, if we get below 10, we get a heads up, which is still an okay trade for some. I just like to wait a day to make sure it doesn't move from heads up to danger zone. Okay, as long as it stays gets back into the green, even if it's the lightest green, we're good with it. But that nat gas trade is probably the best one on the block right now. It's for pure bulls. The IWM, again, would be a good setup, except I just want to make sure, give this to the close Monday to make sure that we don't go below 5, meaning a transition from heads up to danger zone, indicating that the trend is likely over for a while. Okay. So we do have some heads ups to get through here. And so that's for option traders. Then we have the disruptive tech stack, where you're going to see probably the most danger zones. This is everything from clean energy and lithium and infrastructure to the power grid, you name it. It's a narrow category of tech, an ETF that controls some companies that specialize in disruptive, life-changing, game-changing software or hardware or some other technology. Okay. It's been beaten up very hard for most of this year, and there was a huge bill that was just passed in Congress. So a lot of this could be profit taking because there was a big run up on all of this stuff into the legislation that passed. And so this may be a sign to wait for the consolidation and then cherry pick the high tailwind scores after they've had a chance to pull back or start building a position with your buy the dips. Okay. Global trade and commodities. I wanted to point this one out for a couple of reasons. First of all, we want to pay attention to energy. DBC starting to move a little bit. So DBC is a broad basket of commodities. It includes metals, raw materials, and energy, all types, from oil to natural gas. It had been really beaten up. Still, we have the long-term trend is bullish. Buying pressure is back to neutral plus. Relative strength, at least in the 6-month time frame versus the market, and despite the fact that we had a hellacious pullback for energy, is very bearish, but in the 6-month window, still holding strong. Bullish intermediate forecast. Luckily for us, DBC is still holding on to a bearish and basically below 50 and rolling down in the long-term time frame. That's a good thing for inflation. So this one concerns me a little bit. This is what I'm watching. If that turns bullish, that means commodities may start running again. Okay. These are some individual stock selections. These are not just randomly chosen S&P 500 stocks to watch. These have some of the most bullish fundamentals, not just technicals, but analyst ratings, cash flow scores, price to book, analyst upgrades, earnings estimates trading higher, management making their score. We're using several publicly available research services that are attached to major brokerages, like the Fidelity has a stock scoring system that we're using, among others. Okay, and but we don't use Chaikin. I want to be clear about that. The power gauge is off limits. You have to subscribe to get that. Okay, and then we do the same thing with small caps. These actually have to earn cash. No debt allowed. These are stocks actually generating money on their own. Okay, and then these are 2x leveraged. Notice the TBT, bearish inverse ETF at a 58% tailwind score, multiple time frames of bullishness, do have a bearish longer term market posture. But remember, these are shorter term holds. This one is saying that despite the fact that the Fed is raising interest rates, short treasuries, which would mean short treasuries would mean what? It means that treasuries going down, interest rates going up. That is bullish. So if it was bullish bonds, it would be treasuries going down, meaning interest rates going down, but this is suggesting rates going higher. And it's got an intermediate term entry signal. That's where the 10-day moving average crosses above the 40-day moving average. Okay, we're almost done. Dividend dominators. Some traders love this stuff in bear markets. This is a chance for you to get a company that hasn't failed in 25 years to raise their dividend. Some cases it's 40 years, but none of these companies have ever cut their dividend for any reason. Okay. And again, we're using by the day because you don't really time these investments. These aren't get in, get outs because you're playing for that yield, right? And so what you do want to check on is to make sure that the price of the equity is not so high that the dividend yield is under 2%. You really want to, I would say, confirm these trades by checking and making sure you're getting at least a 3.5%, if not 4% dividend. Then it's a perfect world. Appreciating stock, paying a decent sized dividend, and a good entry signal. Okay. And that's it. I think that is enough for today. Thanks for bearing with me. If you like what you see today and like to get those trading signals sent to your inbox, go to stockcheatsheets.substack.com. If you're watching me on social media, you'd be doing me a world of good by hitting the like button on teaching the algorithm to serve me up more to other people who have the same interests as you. I'm trying to build an audience for this. And remember, my goal here is I think this is very powerful data. And the way we've organized it puts you on a level playing field with a lot of institutions who have access to, yes, more sophisticated data algorithms than I do. But this combination of stuff covering relative strength, buying pressure, actual trend performance, and then forecasting trends in multiple timeframes based on the acceleration of price or deceleration. That's a powerful suite of indicators rolled up in one easy to understand score with some entry timing signals that actually make sense, right? Senior timeframes holding in there bullish, junior timeframes showing just a little weakness, but never enough that was going to, hopefully more often than not cause you to lose sleep at night because it crashes through your support levels. That's the idea. We're also using cheat sheets to guard against the first series of data likely to be indicating a big market reversal. I know for those of you on YouTube, see the crash is coming, the sell everything videos, the Peter Zeihan saying, United States will be the only country left standing, but we're about to go through a 5 to 10 year bear market. It's out there. This data will give you the early warning indicator. It'll start with the momentum and the near-term indicators going into the danger zone. Then it will be the intermediate forecast falling out of very bullish to neutral minus to bearish to very bearish, and then finally rolling over the long-term market forecast indicator to from right now weekly bullish. If we go from neutral plus and we roll over where we're at right now, we'll go from neutral plus to bearish. And that means the path of least resistance is lower. So a few down days is all it's going to take to reverse the trend. But you want to know the difference between buy the dip buying opportunity and a trend reversal. Nothing is guaranteed in trading. This comes close and at least gives you a data-driven, consistent way to parse that difference every time. And more often than not, you should be right. Then it's a question of don't trade any one instrument with too much money behind it. Make sure that you can afford to lose money in case the market does conspire against us. Trade with money you can afford to lose and trade small positions and live to trade another day. We'll go up over time. We're in no hurry. This is not get rich quick. This is Cheat Sheets. And I am Mike O'Connor. Thanks for watching. And sorry for the infinity of death signal. Here we go. I'm going to get rid of this now.